And now it's time for Development Debates, where we dig deeper into some of the questions shaping the future and present of China. Today we will see two Chinese experts debate whether the current Chinese tax burden is heavy or not. China could be considered to have one of the highest tax burdens in the world. However, the country's state-owned media and some experts always deny this. They claim the country's tax burden is far less than in developed countries. But from many people's perspective, they have yet to see many benefits from the government's investments. 21st Century Business Herald reports, recently the Chinese Academy of Social Sciences published a report revealing the country's true tax burden. The report indicates that last year the government's fiscal revenue reached nearly 13 trillion yuan. If you divide that number across the country's 1.3 billion residents, the country's tax burden per capita reaches 10,000 yuan. That's equal to $1,600 per capita. Apart from that, another report from the Ministry of Finance shows that Chinese companies were also subjected to heavy tax burdens. The report shows that Chinese companies have to pay more than 40% of their revenue to government taxes. This rate far exceeds the average level in other countries in OECD. The Organization of Economic Cooperation and Development is shortly known as OECD. Statistical data shows that over the past 3 decades, the average tax burden of OECD countries was between 24 and 27%, even though some experts still refuse to admit China's high tax burdens. Li Hui, financial commentator for People's Daily, believes China's tax burden is far less than other developed countries. Li uses government fiscal revenue per capita to measure China's tax burden. The Ministry of Finance claims in 2011, China's fiscal revenue per capita was about $1,500. However, by comparison, this number in developed countries could reach $14,000. So it was only 1/10 of that amount in China compared to that of developed countries. Li points out that if the government spends 2/3 of the fiscal revenue on public programs, then the government from developed countries could spend over $9,000 per citizen. However, the money spent per Chinese citizen is only 1/9 of that. This is why Chinese people complain about the country's high cost for public amenities, such as housing, education, medical treatment, and so on. Data shows that in 2012, the Chinese government fiscal revenue only accounted for 35% of the country's GDP. By comparison, the average rate other countries is about 40%. From this, you can see that China's tax levels are maintained at a reasonable level. However, another financial commentator, Tai Shun-kun, doesn't support Li's idea. Tai writes that the high tax burdens shouldn't only be measured by the revenue or the actual percentage. Instead, it should depend on how much people can benefit from government taxes. Data from the Ministry of Finance shows that only 28% of fiscal revenue was spent on education, medical care, social insurance, and employment markets. However, by comparison, this rate in developed countries could exceed 60%. Tai claims Northern European countries have high tax burdens for ordinary people. However, the government spends most of them improving people's livelihood. This is the reason people don't complain about their government's heavy tax burdens. Some of the Chinese government's fiscal revenue is taken by corrupt officials, while other tax money has been wasted on unnecessary government projects. Only a small amount of money is left for public services. The fundamental reason that led to this situation is the country's lack of supervision on government fiscal revenue. If the country's taxation system was fully under the people's supervision, then people would know exactly where the money went. Perhaps then they might stop complaining about their personal tax burden.